Hello and welcome back to the channel, your go-to source for understanding the complex world of hard-to-borrow stocks and potential short squeeze setups. Today, we're diving deep into a fascinating microcap name that's recently caught our attention, INLF Limited. We'll break down why this stock is displaying some truly eye-popping cost to borrow fees, what that could mean for its future, and what to watch for. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's kick things off with a snapshot of INLF Limited. Share logo/chart trading under the ticker INLF. This company operates in the industrial sector, specifically within specialty industrial machinery. INLF Limited, through its subsidiaries, is a player in the People's Republic of China, focused on the research, development, manufacture, and sale of injection molding machine dedicated manipulator arms under the INLF brand. It's a microcap stock with an estimated float of just 1.0 million shares. Looking at recent price action, INLF has seen quite the roller coaster. Today, it's down 12.53%, but it's gained a significant 42.61% over the last 5 days. Zooming out, the last 30 days show a stark decline of 99.56%. Where is cost to borrow and why it matters? So, what exactly is cost to borrow or CTB, and why do we focus on it? Show infographic of CTB. When you short a stock, you're essentially borrowing shares you don't own, selling them, and hoping to buy them back later at a low price to profit from the difference. For the privilege of borrowing those shares, you pay a daily fee to the lender. This fee is called the cost to borrow. It's often expressed as an annualized percentage, and when it gets extremely high, it tells us that there's intense demand from short sellers to bet against the stock, but limited supply of shares available to lend out. Why the stock is hard to borrow right now? Now, let's talk about INLF. This stock appeared on our hard to borrow screener with an absolutely staggering annualized cost to borrow fee of 717.3%. Highlight 717.3% on screen. Think about that, holding a short position for a full year would theoretically cost you over 7 times your initial investment in borrow fees alone. While we don't have data on CTB momentum or the exact shares currently available to borrow, the 717.3% figure combined with INLF's tiny estimated float of 1.0 million shares is a clear signal that the supply of shares available for shorting is incredibly tight, or the demand to short is exceptionally high, or both. Squeeze mechanics explained. A short squeeze happens when a stock with high short interest and a high cost to borrow starts to rise in price. Show animation of squeeze. As the price climbs, short sellers begin to feel the pressure, especially when those borrow fees are soaring. To limit their losses or avoid paying exorbitant fees, short sellers are forced to buy back the shares they borrowed. This buying activity adds more fuel to the upward price movement, creating a cascading effect where more short sellers cover, pushing the price even higher. Our internal composite squeeze score for INLF sits at 41.0. While high CTB is a key ingredient, it's crucial to remember that it doesn't guarantee a squeeze. Short sellers might have strong conviction, believing the stock will eventually fall, and are willing to pay these high fees to stay short. Dilution risk check. One major factor that can completely negate a short squeeze thesis is dilution. Show text dilution. No concern. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically reduces the value of existing shares and can provide an endless supply of new shares for short sellers to borrow, effectively killing any potential squeeze. For INLF, our checks found no recent dilutive SEC filings like -1, -3, or 424B in the last 90 days. This means dilution risk from new share issuance is not an immediate concern for the squeeze potential. Recent reverse split watch. Another important recent development for INLF is this reverse stock split. On July 6, about 21 days ago, INLF executed a 1:4:200 reverse split. Highlight date and ratio. A reverse split reduces the total number of outstanding shares and proportionately increases the share price. For instance, if you had 200 shares, after the split, you'd have 1 share. This effectively shrinks the float and resets the share price higher. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, though this is a pattern we've observed, not a guarantee of future performance. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given INLF's high cost to borrow, tiny float, and recent reverse split, what should you be watching? Show volume chart. Today's volume for INLF was 195,643 shares, which is significantly lower than its 30-day average volume of 3,051,250 shares. This translates to a relative volume of just 0.1x its average. For a short squeeze to really ignite, we typically need to see sustained, high trading volume, indicating strong buying interest that can overwhelm short sellers. Low volume, like we're seeing today, makes a squeeze more challenging to materialize. Keep an eye on that 1.0 million estimated float. A small float means any significant buying pressure can have an outsized impact on the share price. INLF Limited. INLF presents a compelling case study in the world of hard-to-borrow stocks, primarily due to its astounding 717.3% cost to borrow and very low float. Combined with the recent reverse split and no immediate dilution risk, it's certainly one to keep on your watch list for potential volatility. However, the current low volume highlights the challenge. Remember, this is about education, not recommendation. Always conduct your own thorough due diligence. If you found this breakdown helpful, please like this video, subscribe to the channel for more unique insights, and let us know your questions or thoughts on INLF in the comments below.